if you think of most asset prices versus this debasement, the S&P is doing about 8% a year since 2012, which basically just keeps your head above water. The Nasdaq's done about 17%, but Bitcoin's been doing 150%. And when you look at Nasdaq versus Bitcoin, the Nasdaq is down 99.97%. So it does do very good for your purchasing power, but this debasement is a real issue because most things just don't keep up with the debasement. So you're right, we're not going to have a massive debt blow up. What we're going to have is this ongoing bleeding of all of our purchasing power.
The continuous devaluation of currency is gradually diminishing our purchasing power, creating growing challenges in maintaining financial stability. This is the latest message from Raoul Pal, CEO of Real Vision Finance. Pal underscores the seriousness of currency devaluation, pointing out that many assets fail to keep up with this decline. He highlights that rather than experiencing a sudden economic crash, we are witnessing a prolonged, steady erosion of purchasing power. Be sure to watch until the end of the video, where Raoul discusses how the government might intervene in the crypto market in potentially troubling ways. Also, if you enjoy listening to crypto-related content, please show your support by liking and subscribing to this channel by following the link in my bio and get access to my free daily crypto updates and expert predictions direct to your inbox. Each newsletter contains market intelligence, on-chain data and latest updates from experts in the crypto space. All of this is available completely free of charge. Signing up only takes a moment and you can always change your mind later on. Now back over to Raoul Pal.
ETFs are driven by two: net inflows, or people known as arbitrageurs who are arbitraging the futures market. So we don't know what that flow was. So they would sell the futures which trade at a premium and then buy the ETF. We don't know what that flow was, but let's assume it's net inflows because Binance saw record inflows yesterday as well. So what we're seeing is people, I think, because of the education that you've been doing, I've been doing, Michael Saylor's been doing, everybody's been doing, people are starting to understand the game. And even Larry Fink has been explaining the game. The game is the erosion of your purchasing power, not via traditional CPI inflation, but via this more pernicious debasement idea. And I think people are understanding and have been educated that this is a volatile asset class. And, as I started at the beginning of the show, is if we do get sell-offs, people are starting to realize that's when I buy. That same strategy worked incredibly well in the Nasdaq over the years as well. You've got a big secular trend, any wobbles, generally a buying opportunity.
Solana. What do you think?
Solana is cheap, fast, and there's a lot of innovation coming. And we're seeing lots of nice, easy applications for people to use. So, what drives a blockchain use? Well, nice applications, easy use, and cheapness. So it's really, really blowing out all the metrics versus other chains right now, hence why its price outperforms both Bitcoin and Ethereum. So it's been definitely the big breakout of this cycle, and I think it continues because it's getting a lot of traction. It's just a very easy to use chain that's very fast, and a lot of the applications are just very user-friendly. I think Solana grows massively and closes the gap massively with Ethereum. Different chains are used for different things. Ethereum is securer, is probably the chosen one for the finance industry to build on top of, whether it's layer 2s or whatever, because it's very secure, very well battle-tested, and very respected and still innovative. Solana seems like it's more for retail application and fast-moving applications. Even maybe crypto exchanges can build on the new Firedancer part of it because it's super fast. So I think, to extract away for people watching this, I don't really understand this. It's really simple. Bitcoin, Ethereum, Solana, they're all just decentralized businesses selling block space on their blockchain. And different block spaces have different attributes, and they're used for different cases. So Bitcoin is the single most secure. So right now, its main use case is just Bitcoin itself. And it's perfect in that way. Ethereum, DeFi has really been the big thing. And obviously NFTs were very big, but that's also gone to Solana. So valuable transactions, if banks are going to transfer hundreds of gazillions of dollars between each other, Ethereum is likely the chain of choice. Solana, for lots of rapid transactions, it's the right choice. We will see other things, whether it's Sui, which is the Mistin Labs one, or Avalanche or others for gaming, or for other applications like converting the old Web 2 social media into Web 3 or music. They will all find different blockchains that better suit their purpose. When you invest in the crypto asset class, you expect volatility. If I go back over all the years I've invested, most years you get 2, 3, or even 4 30% drawdowns. This one in Bitcoin has been 27%. It's kind of within the range of normality. And what you need to ask yourself is the main drivers of crypto are the business cycle, i.e. where are we with the economy? Well, we're starting to pick up slowly, inflation's coming down, rates are going to come down, liquidity is going to come in, and so therefore that's usually a very good time for crypto. So the tailwind is behind you. And the other thing, are people adopting the technology? Are things being built on it? And that's ongoing too. So when you see a news event like the last few days, driven by macro factors, you tend to think they're likely to be short term. Now, if the business cycle was getting old and the economy was starting to feel a bit more fragile, then yes, you might be worried about it. But this is early in the cycle, and generally you have to expect the volatility. And how I've always dealt with it is a Jedi mind trick, which is you look forward to it. When it happens, you can buy more, and you get to compound your returns much better than anybody else who just does nothing or tries to trade around it. So you should be thinking of these sell-offs as a gift, as, oh wow, if I can find a bit more cash, I can put it into the market. And you tend to do really well over the cycle by doing that strategy. But even more so, it's generally not the change of interest rates. Nobody really cares if your rate goes from 10 basis points to 25 basis points or whatever, right? What it actually was the move in the yen, because you have to pay back, you're borrowing yen. When the yen starts moving a lot, then that starts concerning you. The yen went up a lot. So suddenly the amount of yen you've borrowed has gone up in dollar terms. So what happens is everybody reduces risk. And that was the real thing, is the Bank of Japan started intervening in the currency market because their currency was too weak. And they started selling dollars and buying their own currency. That's what everybody borrowing yen went, oh my God, now suddenly, yes, I'm getting a cheap pickup in borrow, but bloody dollar yen is moving 2% a day every single day, and I'm losing a lot of money. And what happens is a risk manager comes along at a bank or a hedge fund and goes, you need to close your positions or reduce your risk. And that's really what the last 4 days were all about, was the risk manager tapping somebody on the shoulder saying, listen, you're losing money on this side, you need to start reducing risk. And that's why everything gets hit, from crypto to NASDAQ to mining stocks to oil to anything, any risk at all. But these tend to be very short-lived because, once the market resettles, they get used to the change, people have been washed out of positions, it then kind of settles back to normalcy. And these, I call them macro spasms, they don't usually last very long. Could it last a week? Could it last 2 or 3? That's possible. 2016 saw very similar. The dollar had been very high. The world economy was super slow. World trade had slowed down because the dollar was so strong. And the Japanese came in and intervened in their currency. All the markets blew up. Exactly the same mechanism. But what happened after that was the central bank started stimulating, particularly the Chinese, because they've been waiting for this moment to do so. The Europeans last time around and the UK last time around. This time, I think it's going to be the Chinese who are going to stimulate. And why they get to stimulate is they couldn't do much cutting of interest rates or stimulating of monetary policy because their currency was too weak and they didn't want to lose control of it. But now the dollar has weakened, they're able to do more. So I think really it's probably a net positive. Just give it a few weeks and it's probably very positive. Firstly, it depends when these events happen. If the economy is rolling over after you've had a strong period, inflation has been rising, the Fed are raising rates. If it happens then, it can risk turning into something bigger. When you're the opposite, which is the business cycle is just turning up now, the Fed are cutting rates, the probability of this being a bigger event is significantly lower. So from that probability, less so. The other thing is something happened in 2008 that has stopped a lot of this. In 2008, the central banks discovered the money printer. And the money printer, and you and I have talked about it on this show before, essentially is debasing the currency by printing more currency. Now, it's dressed up in a nice term called liquidity these days. It used to be quantitative easing, but they find different ways of doing it. When they print more currency, it makes the value of the purchasing power of that currency go down versus scarce assets. So it makes assets go up. So now every 4 years, in fact, that we've come close to something that could be nastier, they've started printing money. And it's not just the US, it's everybody, all the main central banks. And that has kept a bottom under markets. Even in 2022 was a bit trickier because we had inflation. So it was hard to print money. But eventually when it got to it, when the S&P was down about 30%, they kind of went enough's enough. And they started printing money again. So I don't think there is a lot to fear. In fact, I would be so outrageous to claim the probability of a down 50% market is now miles smaller than it was when you and I grew up, when it was a common occurrence that we would see it. We won't see this again because of the money printer.
Thanks for watching. Please don't forget to subscribe for news and expert predictions direct to your inbox.